Let's talk about a real mystery. In a quiet office in Omaha, Nebraska, there's a guy who, by all modern rules, should be a financial fossil. No blinking screens, no algorithms, just a desk, some annual reports, and a can of cherry Coke. For decades, Wall Street has been a high-speed demolition derby. Yet this man hasn't just survived, he's dominated. How? How is it possible that in a world obsessed with speed, the guy who moves the slowest consistently wins?
I mean, just look at these two worlds. On one side, you've got Wall Street. It's a blur of screaming traders and data streams moving at the speed of light. It's a war zone where speed is everything. And then there's Omaha, where the most common action is, well, no action at all, where the main strategy is just sitting and waiting. The contrast is it's jarring, and it forces you to ask a really uncomfortable question.
Seriously, how does that work? How can a strategy of doing nothing for years at a time just crush a world that never ever stops moving? Well, the answer isn't luck. It's actually pretty simple. He wasn't playing their game, not even close. He was playing a completely different game with a completely different rulebook. And today, we're going to tear that rulebook apart and see what's inside.
Now, what we're about to get into, these aren't just clever investment tips. Think of them as psychological armor. They're designed to protect you from the madness of the market, sure, but more importantly, they're designed to protect you from the single biggest threat to your money, yourself.
Okay, so lesson 1 is all about two things: boundaries and castles. The first part, boundaries, isn't about figuring out what to buy. It's about having the incredible discipline to ignore almost everything. And the second part, castles, is about defense. Once you finally find something worth owning, you better make sure it's an impenetrable fortress.
This brings us to a really powerful idea, the circle of competence. Now, this has nothing to do with being a genius who knows everything. It's the exact opposite. It's about being humble enough to admit what you don't know. It's about drawing a very small circle around the things you truly, deeply understand, and then having the discipline to never, ever step outside of it.
Let's put you in his shoes. It's the late 90s. The dot-com bubble is raging. Your friends, your neighbors are all getting rich overnight on tech stocks you've never heard of. Meanwhile, the media is calling you an old, washed-up dinosaur because you're sitting it out. That fear of missing out, that FOMO, would be absolutely suffocating, right? The pressure to just jump in would be immense. But Buffett didn't. He stayed in a circle. He asked simple questions like, can I predict what this business will look like in 10 years? If the answer was no, he just moved on. And when the whole thing imploded, wiping out trillions of dollars, his portfolio was just fine. He proved that avoiding a huge mistake is way more powerful than chasing a brilliant success.
So let's say you've found a business inside your circle. Great, but is it a good one? You got to remember, in capitalism, big profits attract competitors like sharks to blood. So to survive, your business needs a defense. It needs what Buffett calls an economic moat. I want you to picture your company as a castle, and the profits are the treasure inside. The moat is whatever advantage it has that keeps all those other companies from climbing the walls and stealing the gold.
And these moats, they come in all shapes and sizes. Take Coca-Cola. A competitor could have $100 billion, but they can't buy what's in your head. That memory of a cold Coke on a hot day. That's a powerful moat. Or think about See's Candies, one of Buffett's favorites. They have what's called pricing power. You don't buy a cheap box of chocolates for someone you love. You buy the brand you trust, almost no matter the cost. When a company can raise its prices year after year and its customers actually thank them for it, that's when you know you've found something special. But here's the catch. Even the most amazing castle, with the widest moat, sitting right in the middle of your circle of competence, can be a horrible investment. If you make one huge mistake, you pay too much for it. This brings us to probably the single most important risk management tool in all of investing. And it comes down to just 3 simple words: margin of safety. Think about it like this. If you're an engineer building a bridge that needs to hold a 10,000-pound truck, you don't design it to hold exactly 10,001 pounds. That would be insane. You build it to hold 30,000 pounds. That massive cushion, that extra capacity, that's your margin of safety. It's what saves you when things inevitably go wrong.
Here's a real-world example. Back in the 70s, the market was terrified, and the Washington Post Company was for sale for about $80 million. But Buffett did his homework. He looked at all its assets separately, the newspaper, the TV stations, the real estate, and calculated they were worth at least $400 million. He wasn't just getting a good deal. He was literally buying a dollar for 20 cents. The gap between the price he paid and the actual value was so huge, it was almost impossible to lose money, even if he was a little bit wrong in his calculations.
Okay, here's the thing. The math we just talked about, it's easy, like 5th grade math easy.
Anyone can do it. The hard part, the part where almost everyone fails, is the psychology. It's mastering your own emotions. And Buffett has two incredible mental models to help you win this fight, starting with giving the market a personality. So I want you to imagine that you have a business partner named Mr. Market, and he is not well. He's a manic depressive. Some days he shows up at your door totally euphoric, screaming about how great things are, offering to buy your shares for a ridiculously high price. Other days he's a sobbing mess, convinced the world is ending, and he'll beg you to take his shares for pennies. Now, your job is to use him, not become him. You buy from him when he's terrified, and you consider selling to him when he's euphoric. But most people do the opposite. They let his mood become their mood. They let a maniac run their financial life. Take Black Monday in 1987. The market dropped 22% in one day. Can you imagine losing almost a quarter of your life savings between breakfast and dinner? The panic was total. Mr. Market was having a full-blown breakdown. But what was happening in Omaha? Nothing. Absolute silence. Buffett didn't sell a single share because he knew that while the prices of his businesses had changed dramatically, the businesses themselves had not. People were still drinking Coca-Cola that day. The world hadn't ended. We've all heard this quote, right? It's easy to nod along to it when the market is calm, but actually living it, it's brutally hard. Buying when everyone around you is in a full-blown panic feels like jumping in front of a train. Your every instinct screams at you to run away with the herd. The ability to just stand still and think rationally in that moment, that isn't just a skill, it's a superpower. And that superpower comes from the final mental shift, the owner's mentality. You have to stop seeing stocks as blinking lottery tickets on a screen and start seeing them for what they are, tiny pieces of an actual business. Look, if you owned a farm, would you get a price quote on it every single day and panic if it went down? Of course not. You'd focus on the crop yield. That shift in perspective changes everything. Your timeline goes from days to decades, and you stop interrupting the magic of compounding, that little snowball of wealth that needs a very, very long hill to become an avalanche. So, we've got the whole toolkit, right? Circle of competence, economic moat, margin of safety, ignore Mr. Market, and think like an owner. But here's the thing. Knowing the rules of the game is one thing. Playing it when the stadium is on fire is something else entirely. Let's fast forward to 2008. The entire global financial system is on the brink of collapse, and Buffett's entire philosophy is about to face its final exam. I mean, just look at how fast this was all happening. One day, Lehman Brothers disappears. The next day, AIG, a giant, collapses. The credit markets, the actual plumbing of the economy, just freeze solid. The headlines were apocalyptic. Everyone was running for the exits, dumping stocks, hoarding cash. The fear was so thick, you could taste it. And right in the middle of all that chaos, Buffett gets a phone call. It was Goldman Sachs on the line. While the rest of the world was convinced capitalism itself was broken, Warren Buffett calmly wrote a check for $5 billion. This was the ultimate test. It was everything we just talked about in action. He saw a great business with a huge moat inside his circle of competence being offered at a fire sale price because Mr. Market was absolutely terrified. He wasn't trying to call the bottom. He was just taking advantage of an incredible bargain. And then he went public, publishing this op-ed in the New York Times. It was such a simple, powerful message of confidence when nobody else had any. And you know what? The market kept falling after he invested. It dropped another 30%, and people called him crazy. But he didn't care. He wasn't playing their short-term game. He was planting an oak tree in the middle of a hurricane, knowing with absolute certainty that the sun would eventually come out again. So let's go back to our original question. How did the slowest man win the fastest game? The secret wasn't a complex algorithm. It wasn't some genius level IQ. The answer was something much more human, and believe it or not, something that's actually accessible to all of us. The secret weapon was temperament. Just temperament. It's the ability to stay calm and think for yourself when everyone around you is losing their mind to greed or fear. The financial industry wants you to think this stuff is complicated, so they can charge you big fees. But Buffett's true legacy is showing us that you don't have to be a rocket scientist. In fact, most of the time, the more you trade, the more you do, the worse your results are going to be. This single quote really says it all, doesn't it? The stock market is just a giant machine that takes money from people who can't wait and gives it to people who can. All those lessons we went through, the circle, the moat, the margin of safety, Mr. Market, they're all just tools designed to do one thing, to force you to be patient. They're defenses against your own worst instincts. Look, following this path is not easy. It can be lonely. You're going to feel like an idiot when other people are bragging about their quick wins. You'll feel crazy buying when every headline is screaming at you to sell. But the goal here isn't excitement. It's building real, lasting wealth. So, in this great game of transferring money, you just have to decide which side you're on. Are you one of the impatient or one of the patient? The only question left is, which one are you?